Welcome to Financial Market Insights for Traders, the show where we break down markets, strategies, and smart investing moves so you can grow your wealth with confidence. I'm your host, Sophia, and today's episode is packed with practical insight you do not want to miss. We're diving into the fundamentals of the bond market with a sharp focus on how to invest in bonds for beginners and how the bond landscape is evolving in 2025. If you're looking for stability, passive income, or a smart way to diversify your portfolio, bonds might just be your new best friend. Let's get into it. So let's start with the basics. What exactly is a bond? A bond is essentially a loan. When you buy a bond, you're lending money to a government, municipality, or corporation. In return, they pay you interest called the coupon, and at the end of the bond's term, they repay the principal. Simple, right? But don't mistake simple for unimportant. Bonds are one of the cornerstones of global finance, and understanding them is essential for building a smart, well-rounded portfolio. Let me walk you through the key components of a bond. Face value, also called par value, is the amount you'll be repaid at maturity. Usually, this is $1,000 per bond. The coupon rate is the annual interest the bond pays, expressed as a percentage of the face value. Maturity date, that's when the issuer pays you back. The issuer is who's borrowing your money. The U.S. government, a city, a corporation, you name it. And then there's yield, which is your actual return. This considers how much you paid for the bond and how long you hold it. Now, here's the real question. Why should you care about bonds in 2025? 3 big reasons. First, rising yields. With interest rates elevated, newly issued bonds are offering stronger returns than they have in years. We're talking 5% or more in some cases, low risk and not bad at all. Second, market volatility. Stocks and crypto are all over the place. Bonds, on the other hand, provide stability. When the markets are shaking, bonds don't panic. And third, diversification. Bonds often move inversely to stocks, so they balance out your risk. That's a major win, especially if you're trying to smooth out your portfolio performance. Let's break down the different types of bonds available and which ones make sense for different types of investors. 1. Treasury bonds. These are issued by the U.S. government. They're considered the safest investment on the planet. Maturity, 10 to 30 years. Great for anyone who values low risk and long-term income. 2. Treasury bills and notes. Shorter-term government debt. T-bills mature in less than a year, while T-notes are 2 to 10 years. Great for liquidity and capital preservation. 3. Municipal bonds, issued by local governments and often tax-exempt, especially at the federal level. Great for high-income investors who want tax-free income. 4. Corporate bonds, issued by companies. These carry more risk than government bonds, but offer higher yields. Split into 2 categories. Investment grade, relatively stable. High yield or junk bonds, higher risk, higher return. Great for investors with a stronger risk appetite. 5. Bond funds and ETFs. These are portfolios of bonds you can invest in just like a stock. Perfect for hands-off investors. Great for beginners who want instant diversification without picking individual bonds. Let's walk through a step-by-step process for how to invest in bonds for beginners. Step 1. Know your goal. Are you looking for monthly income? Safety? A hedge against stocks? Define your reason first. It drives everything else. Step 2. Assess your risk tolerance. Government bonds? Safe. Corporate bonds? More yield, more risk. Junk bonds? High yield but high stakes. Match the bond type to your comfort level. Step 3. Choose your method. Direct purchase. You can buy individual bonds through a broker or U.S. Treasury site. Bond funds or ETFs. Easier, more liquid, and automatically diversified. Manage portfolios. Let professionals handle it for you. And if you're looking for a platform that's intuitive and world-class, let me recommend Crystal Ball Markets. Their cutting-edge, user-friendly platform makes it simple to buy bonds, ETFs, or any asset you're exploring. It's seriously one of the best ways to get started. Step 4. Understand interest rate impact. This is crucial. When interest rates rise, bond prices fall. If you buy a bond at a low interest rate and rates go up, the market value of your bond drops. That's why many investors are going short term in 2025 to manage risk. Step 5. Know your ratings. Stick to investment grade bonds, rated BBB or higher. Ratings agencies like S&P, wink with tongue sticking out, and Moody's provide this info. The lower the rating, the higher the risk of default. Step 6. Ladder your bonds. A bond ladder is a series of bonds with different maturities. As each matures, you reinvest. This spreads risk and smooths out cash flow. Even though bonds are seen as safe, they do carry risks. Interest rate risk. Rising rates can lower your bond's market value. Credit risk. The issuer could default. Inflation risk. Your fixed payments might not keep up with rising prices. Liquidity risk. Some bonds are hard to sell quickly. So, do your homework. Diversify. And always match your investment to your personal goals. Let's take a look at what's shaping the bond market this year. 1. Green bonds. Investors are pouring capital into environmental and socially responsible projects. ESG bonds are not just ethical, they're growing fast. 2. AI-powered platforms. Tech is making bond investing smarter. Platforms now offer AI insights, risk models, and custom recommendations, perfect for beginners and pros alike. 3. Short-term bonds with high yields. With rates where they are today, even short-term treasuries are offering solid returns. Less risk, decent reward. If you want to really level up your understanding of bonds and the markets in general, I've got 2 amazing resources for you. First, head over to Crystal Ball Markets podcast. It's beginner-friendly, real talk about trading, investing, macroeconomics, and market psychology. No jargon, just clarity. Second, get started with the crystalballmarkets.com trading app. Seriously, it's one of the most intuitive platforms I've seen. It's sleek, reliable, and has everything you need to build a smart, modern portfolio. To wrap this up, bonds aren't boring. They're powerful tools for generating income, reducing risk, and building wealth. Especially in 2025, they deserve a spot in nearly every investor's portfolio. You've now got the tools, the strategies, and the insight. Whether you're starting with $100 or $10,000, you can invest in bonds confidently. Direct hit, take action. Subscribe to the Crystal Ball Markets podcast for more market insight every week. And get started on your investment journey today with the Crystal Ball Markets platform. I'm Sophia. Thanks for listening to Financial Market Insights for Traders. Until next time, stay smart, stay informed, and keep building your financial future.